What is it we're trying to achieve? Why are we here for? What is our purpose? Those are the questions that we should be asking ourselves all the time. But I think in times of carnage, in times of fear, in times of market correction, in times of volatility, I don't know, whatever you want to call this situation that we're in right now, I think it's incredibly useful to do that. Today, the market for a while was down. The Nasdaq was down almost 4%. It ended up closing up. So we're definitely in times of extreme volatility. Let's leave it at that. And the reason we have this type of situation is driven by a couple of factors, and I'm going to discuss them. But the main purpose of this episode is to remind ourselves, why are we here for? What is our purpose? This is the Not Even Wrong podcast. It's January 24th, 2022. This is Crimdelco. For the day, the fund is down 47 basis points. The market's up 28 basis points. For the year, we are down 16.7%. The market is down 7.6%. We're underperforming by 9.1%. So today was one of those days where we thought that hell broke loose, and then actually the market recovered towards the end of the day and finished up. So whatever was happening, I can only, of course, conjecture what was happening today. But here's the way we think about the markets. First and foremost, whenever these types of extreme moves happen, we have some people blowing up somewhere. Now you might say, well, that happens all the time, but when big fish blows up, when there's big carnage, when there's big margin calls, then of course that can move the market. Is it Cathie Wood? Is it somebody in the crypto space? Maybe it's both. Maybe it's Cathie Wood and crypto. It feels like that, particularly because during the day we had a sharp recovery of the biotech stocks, and that just leads me to believe that maybe she was liquidating some of her ARC KG funds, and then once that was done, there was a massive recovery. I don't know. I'm just guessing that we have a situation where either hedge funds and or market makers are blowing up, and we have massive corrections. This is typically what happens. I think it's almost certain that we have a situation like this in the I would guess in the crypto space. We all know that DeFi and all that stuff was basically a levered way to play financial markets, and I think this, as they say, the chicken are now coming home to roost. This is probably what's going on, but that's not the main purpose of this episode. The main purpose of this episode is to give people a sense for what we're here for, to remind ourselves, why are we here for? So the purpose of Orange Capital Partners is to give people, the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And the purpose of Orange Capital Partners as a fund is to create wealth by investing in fundamentally new concepts and engineering practices. This is the purpose. So in none of this mission statement are we talking about macro stuff, people blowing up, volatility, none of that stuff. Why am I mentioning this? I think it's very important to understand that what are the things we're not doing. And some of the things we're not doing are trying to time the market, trying to take advantage of volatility, all that type of stuff. That's not what we're doing. That's not our forte. We don't have technology, we don't have expertise. We just don't do it. It doesn't mean it's a bad thing to do. It doesn't mean people who do it shouldn't be doing it. All that stuff. We just don't have the expertise. We don't have the desire also to time the markets like this because we don't know how to do this. So this is, before we even go further, what we're interested in is finding situation where wealth creation is happening through businesses, through the incorporation of fundamentally new concepts and engineering practices into instantiation of products and services that then lead to markets, and therefore wealth is created. This is what we're interested in. Our largest position is Tesla, and we're also invested largely in the CRISPR index. We have a position in Bitcoin. I'm going to talk about this a bit later if I have time. The focus is here on Tesla and the biotech stuff. Tesla is a company that is using fundamentally new concepts and engineering practices to change certain markets and create new markets. Clayton Christensen will call them disruptive. Tesla is a disruptive company. We don't like the word disruption that much because it's being used for many things and in many contexts that, in our view, is a little bit sort of diluting the value of the word. But within its core concept, disruption is still a very interesting concept, because what disruption really means is that we use technology to lower the cost or the entry barriers to do something that we weren't able to do before. And therefore, we're hopefully also doing good things. For example, freeing the world of fossil fuels, increasing transport, the use of artificial intelligence in transport, things along those lines. We're also trying to solve problems. I mean, this is the key. So this is not just about creating markets and wealth. We're solving problems. For example, the problem of fossil fuels. It's a problem. You can argue about climate change as much as you want. It's not okay to drill for oil and burn the oil. That's not okay. If we can solve that problem somehow by having a better solution, we should do it. And this is what Tesla is doing. So this is along the lines of what we invest in and how we feel about investing. The reason of the sole purpose of Orange Capital Partners is to create wealth. We are measured by the amount of wealth we're creating. Wealth is the measure of freedom is wealth. So we're creating freedom. We've said that many times before the podcast. So we are happy to create wealth for our customers because it frees them up to do things that they want to do. We have liquidity. We create wealth. You have access to money. All these things are incredibly important when it comes to the concept of freedom. Now, when we have these types of drawdowns like we have right now, we're down 16.7% for the year. We're down peak to trough, actually even more, probably more along the lines of 30%. When we have these massive drawdowns, of course, we need to go and think back, okay, what is it we're trying to achieve? Why are we doing this? And why are we putting up with this type of volatility? And the answer is that the wealth creation in itself, so creating wealth with fundamentally new concepts and engineering practices, is just laden with volatility, because we have this concept of natural volatility, which basically says, listen, there are certain things that projects require and uncertainties that projects sort of are inherently prone with, and the more actually uncertainty we have, the more upside we have. So we have to find a sufficient frontier. And there is a certain natural volatility that a company will bring to the table through its application of fundamental new concepts and engineering practices. The more fundamentally new concepts and engineering practices are being deployed, the more we're trying, the more we're daring, the higher the risk, the higher the upside. So where is the sufficient frontier? This is up to the entrepreneurs to find out. We are employed by entrepreneurs. They employ our capital. We are employees of our entrepreneurs. We're not the wealth creators ourselves. We're employing ourselves through our capital with the entrepreneurs that create the wealth. The buck stops with the entrepreneur. We hire our investors to give us capital so we can then be hired by entrepreneurs to our capital, and the capital of our investors can be hired by entrepreneurs so they can create wealth. This is the value chain, and make no mistake, we are not the wealth creators here. We are employed by the entrepreneurs. The entrepreneurs are the wealth creators. As an entrepreneur, I think 0 to 1 is probably the best, I would say the best way to think about it, because the way Peter Thiel thinks about it is the entrepreneur or the startup is the least necessary amount of people to solve a problem. So there's some people that have operational experience, a bit of capital, a bit of and then there's the entrepreneur, the person that actually puts it together, the person that has the energy to make it happen, to ask for it. I want this, and then go and get it. That's the entrepreneur. So within that context, we now have to ask ourselves, okay, how do we sustain macroeconomic turbulences like financial crisis, wars, things like that? And I would say most of the time we're fine. I think if a meteoroid hits the earth and destroys the earth, then probably we're not okay. But if there's World War III, we're going to have tough times. But even then, you can't really destroy a company like Tesla that easily. When I say that, I mean that we have a lot of cushion of safety, a lot. Because the concept of creating wealth through fundamental new concepts in engineering practices inherently also has a margin of safety, because you can't compete it away, you can't really regulate it away. There's no throats to choke, there is none of that stuff. So it's very difficult to actually kill something like that, which is, from a perspective of, okay, how safe are we, is a nice thing to have. Now, when there is very large amounts of volatility, then we as investors have to be very conscious about leverage. This is the key to our survival, because no matter what we do, no matter how fancy our ideas, and no matter how much impact our investments have on the world, if we don't survive, it's nothing. It doesn't help us. So we need to be able to survive. We need to be able to not be erased from this earth financially. We need to make sure we don't lose all our money. And leverage is one of the things that can kill us. So we manage leverage very carefully. We're meticulously obsessed with leverage. That's very important. We obviously, and leverage is, by the way, not just the kind of leverage we have in the fund, which is roughly 18-19% right now. So it's also our cost of living. We as investors have to behave like our companies that we invest in. Disruptors have to have a cost structure that's sustainable. We have to have a cost structure that's sustainable. So this is very important. A lot of investors forget that. They want to invest in fundamental new concepts and engineering practices, but they themselves don't do anything new. And they also have a cost structure which doesn't support volatility, natural volatility. So those are very important concepts, and we have to be very conscious about them. So that's another very important thing that I think in times like this is worth mentioning. So to summarize, the purpose of Orange Capital Partners is to create wealth by investing in fundamental new concepts and engineering practices. The way we do that is by letting entrepreneurs that have the wealth creation capability, let them hire our capital. So we're hired by them. We're not the wealth creators. They are the wealth creators. We have to make sure that we manage our capital in a way that we don't blow up when there's tough times. And we have to make sure that we also have a cost structure that sustains natural volatility. Those are the main key ingredients of our existence. And in times of this, when volatility is very high on the macro side, that's part of life. We can't undo that. That's not something we did. That's not something we did this to ourselves in our portfolio. This is something that has to do with the macro side of things. And we of course have to follow that in a sense that we have to make sure we don't blow up as a country. But then honestly, there's not much we can do about it. There is a time maybe when we have to decide, so are we just gonna liquidate everything and run away? Liquidate in what? What is it, dollars, gold, diamonds, Bitcoin? So those are questions that we're not asking ourselves right now, but we should at least have answers to that. And to be honest, the answer is probably when the shit hits the fan, we should be liquidating everything into cryptocurrency and then go to a place like Switzerland. But again, we're not there yet. We have the deterioration of institutions in the US, which is very concerning. Those are scary things to think about, but that's not much. There's not much we can do other than run away. So this is not actively managing our portfolio or anything. This is managing our lives. When it comes to our portfolio, we have the assumption that the political and social fabric of the society will roughly stay the same. And I think the pandemic has put the social fabric on test. The social fabric all over the Western world is definitely highly corrupted. And this is a whole different episode. What's important right now is that we expect our institutions, at least in the United States and the Western world, to hold on to some sort of normalcy. that also by checks and balances, by correction, we had a lot of the misguided pandemic policies are being corrected as we speak. I think the way we need to solve this problem is by assuming it is like a flu and deal with it like it's a flu, and people have to stop being scared and people have to go back to work. Those are the only solutions that are at our disposal. There's nothing else we can do about this pandemic. And then hopefully other misguided institutions, the high government debt, the inflation, all these things will fall into place also. But having said that, as far as our portfolio is concerned, we are focused, we are laser focused on the fundamentals of our businesses, which are sound. We believe that Tesla and the biotech companies will both do better, actually, if there is a recession. So because it will free up supply chain and it will open up markets, and since there is demand for these products, because they are solving massive problems, we believe that these companies will eventually do even better in a recession, and our portfolio as well. Thank you.